Privileged to be invited to with such a formidable competitor, actually.
Awesome. I think that's what we thrive for, to really grow the pie. And I want to start by asking you, Maurice, you had your roadshow this week, very big week for you. And I want to hear maybe a bit about some of the takeaways from it. But first, I would like to ask, why did you call it Eyes Wide Open?
Oh, yes. Each year we come with a title. Last year it was Winds of Change, bold political leadership, to say things politely, and new technologies. It was these two forces that were to shape markets last year, and still this year, actually. And last year it was a lot about geopolitics. At the end of the day, what happened was driven by the tariffs. The most important factor was a weaker dollar, and that explains, gold skyrocketing, emerging market stocks doing a lot of things. Then 2026, maybe a bit more about the other wind of change, which is technology. So Eyes Wide Open, it's about vigilance and selectivity, because to some extent, we have more of the same compared to last year. Last year was outstanding for investment, frankly, beyond our own expectations. It's more of the same. I mean, the economy is resilient, inflation is under control, growth should continue to be okay. We have AI investment, we have a tax refund in the US. It's more of the same with less visibility, because we have questions on the labor market. Is it already AI that bites into hiring? We don't know. If the labor market stays low, maybe we'll have slowdown risk. If it rebounds, we may have inflation risk. So we have more of the same with low visibility and less upside potential, because valuations are much richer, of course. And finally, we also have behavioral factors that will make things complicated. Last year, many people thought that many people were negative. They said Trump will destroy the economy. AI is a bubble, pretty much. It's not the case anymore. There is a Bank of America Merrill Lynch bull and bear indicator from 0 to 10. Above 8, they say you should sell. We are at 9.6. People are super bullish. So with all that, vigilance and selectivity. Vigilance, asset allocation, portfolio construction, you are an advocate for that, and that's a big difference between you and other digital platforms. Be diversified and everything. Don't hesitate to adjust your exposure. There will be volatility and selectivity, because we think it's more below the line of asset allocation that there will be opportunities. It's not that much about big factors. It's about the winners and the losers. Not everyone will win. Should it be companies, countries, projects, whatever.
Amazing.
Sorry, long answer to a short question.
No, it's great. You picked a lot of themes, because that's something we see amongst our Sarwa investors, where one thing I've noticed is sometimes institutions are more bearish than retail. We've seen retail more bullish, a lot more conviction. They've been buying Max 7, even Bitcoin, commodities for the last 3 years, despite a lot of fears around bubbles. So I'd love to ask you specifically around the AI theme. That's a big theme. There's compelling stories on both sides. On one hand, there's a lot of concentration, high valuations. On the other, it's very transformative. What made you, after 3 double-digit strong returns, say this is going to continue rather than have a bearish view like some other firms?
When it comes to the macro factor AI, there's absolutely no doubt. I mean, it's real. We all use it, and it's only going to increase. And there is a good reason for that, is that everybody needs productivity. That's how it is. You have countries that are, especially in the old world, that are super indebted with aging population. You need growth to face your debt. And if it doesn't come from population, it comes from productivity. So the race is on. And productivity in the last 20 years, it was like a 1% increase per year. And you have forecasts for AI to add anything between 0.5 and 1.5, and I exclude the most bullish. I mean, it's massive. It's massive, and in terms of GDP, it could add $15 trillion in 5 years to the global economy, which is pretty much one India, one Japan, one Germany, and one Canada. Enormous, 2 trillion for hyperscalers. So it's real. There is a race for leadership, because in tech it matters. So there are exorbitant investments, and we think that these investments are. We are not in a bubble. We are quite confident in that. However, what we question, I'm going in every direction, sorry, for the pure AI hyperscalers, they invest. We may have questions 5 years down the road, because these data centers, maybe we will have overcapacity. We are nowhere near that, but maybe one day. We don't know who will win. We don't know what value you retain being the infrastructure owner. And we made mistakes in the past. In the telecoms, for example. I started investment in '98. I did many mistakes. I thought that makes me laugh, but the internet service provider was the one that was going to make a fortune, and it was absolutely commoditized. So in 5 years, we don't know if these data centers will be worth this investment. We don't know who wins. We don't know if there is obsolescence risk, but AI is for real. So it's not necessarily about the hyperscalers. Currently, we look at the bottlenecks that we have. Energy is an obvious one, and it's difficult not to be bullish on energy. And then memory is another one. I mean, it's not just chips. Of course, NVIDIA rules, but we're seeing specialized chips that will do not training and inference like NVIDIA does, but maybe just inference and maybe a bit 20% slower than NVIDIA, but if it's at half the cost and you can do that anywhere, it works. And I'm going in all directions. And China, I mean, we've all seen DeepSeek, Moonshot. They are getting close.
Let's talk about that. So it sounds like the AI transformation is really, it's very difficult to identify the winners, as with every transformation. Emerging markets in China, since I'm a kid, I always hear high GDP, high growth, that's going to lead to incredible performance, but it never really materialized. What made us, if it does, is it any different at the moment for emerging markets and China specifically to break away from this underperformance?
You're right. You're right. I'm a strong believer in emerging markets forever, and we have had a kind of a lost decade of emerging markets compared to, let's say, US stocks, because Europe didn't do much. For me, it was a lot about this technology and an age of efficiency, let's say, where technology was generating super profits, and the US was alone. Now, China, my belief is that there are two stories in emerging markets that you shouldn't miss. I have no clue on the timing, but in 5 years, I'm super confident. The first is India. I'm super confident in 5, 10, and 20 years because it's a GDP per capita improvement story. India GDP per capita is like $3,000. China is 13. There's no reason why this gap is so wide. It will. I'm not saying India will go to 13, but if you go from 3 to 6, first you become the world's third largest economy, and second, from 3 to 6, it's not. You will not be. It's not AI substitution risk. I mean, if you're, I don't know, a consultant, an accountant, a taxi driver, a surgeon, one day you are threatened by AI in the Western world. India, from 3 to 6, you're not. And then China. I think that China is now in a second phase. The first one of what I see as a genius strategy was to replace the US as the world's top trading partner. It's done. It was done through low labor cost, but now we all see in the auto sector, in AI, in everything, they go up the value chain and they offload this low labor cost to other countries, and they build a network. And I think that now their focus is to become the US, to have a middle class that consumes, to be more self-sufficient and to be an empire. And I think they will succeed. In China, they train more engineers every year than pretty much the US and Europe combined. I think it's not something to overlook. Timing-wise, I don't know. The governance in China's Chinese company, sometimes you have the government saying, I don't like this CEO, let's take him in a camp for 6 months or whatever. You have this kind of risk, which you don't have in India. But both countries, I would say China for 5 years and India for the next 10.
It's a very good segue into gold, actually, because I think when people are observing these shifts, one way that we've observed on our platform is a huge rise in gold and commodities. Yeah. There's gold and then there's silver, and they're a bit different. And I'd love your take on that, because I remember last year, even before the surge, you went overweight or at least some exposure to gold.
Oh, yes.
We've seen it really pick up. It surprised everyone in the last few months, including gold and silver as well, more related to the AI trade as well. So where does that leave you when you have to come up with your allocation for 26 and you've observed a much stronger pull? Do you keep your conviction, or do you start to doubt it because you've seen a lot of speculation and a bit of a scope creep from a safe haven asset into maybe something else?
Yeah, it's an excellent question. And of course, gold is hot. Last year, and thank you for remembering, yes, we were overweight. We were overweight for 3 years on gold. And last year, we do fair values every year. And we said gold should rise by 30%. And people were laughing at us, and it ended at 65. I mean, even ourselves, it was much more than what we thought. Gold, basically, and I would make a difference between gold and other commodities. I don't want to go into too much detail, you tell me, but gold is the currency you cannot print. And at a time when when the dollar is a bit challenged. You know, the dollar, it's like the US is less than 5% of the population. The dollar is 90% of the FX trading. And central banks are buying less US treasuries. That's just how it is, and they buy gold, because if you are a bit wary of the dollar, currencies are pairs. You know, what do you put in front? Yen, 250% debt to GDP, dying population. Euro, there's a big question mark. Gold is the currency you cannot print, and it's also an asset that is a liability for no one. If you have a bond, it's someone else's liability. If you have an equity, it's also someone else's liability. Gold, it's not the case, which is a similarity with Bitcoin, by the way. And we think that this makes absolute sense, especially as we are bullish. We think that the world is going with these AI investments. You require old world commodities. You need copper, a ton of that. You need this rare earth that everybody's rushing for. You need energy, and we think we're in a bullish cycle for commodities, and gold is always early in that. So yeah, we like gold without a doubt. We recommend. In our moderate profile, which is at a 5-year time horizon, we currently recommend a weight of 8%. Mm-hmm. And maybe to finish on the market action this year, which is crazy, in January, in the first 3 weeks, gold was up 25%. And then it lost 12%, 8% in 1 hour, I remember. Mm-hmm. And I was like, that's ridiculous to lose 1% in 1 hour. But then I realized it's as ridiculous to gain 25% in 3 weeks. And there is a competition between central banks and us. Investors, speculators, retail investors, small savers. There is this competition, so we are in a volatility, but frankly, it's the currency you cannot print, and this is priceless, I think.
I want to get into what happens behind the scenes when these drops are happening. But before that, I just want to finish touching on the big asset classes. Bitcoin. Yeah. Especially like yesterday, I was looking at our data. We saw incredible amount of buying the dip. It's tanked roughly 50% from, or almost 50% from its top. How does that happen at either personally or at ENBD? And I'd love to see if there's a forming point of view on it, especially with what's going on, that really tests probably the conviction to add it into an allocation.
Absolutely. First, we don't officially recommend Bitcoin. However, I can tell you, we just opened the possibility with our risk compliance and even the regulator to put it in our asset allocation, because we think that Bitcoin has the same role as gold. Again, it's an asset that is not a liability. 21 million Bitcoin, there won't be one more. So there is this scarcity, and with adoption comes trust, and we think it works. And we are about to consider adding it to our asset allocation. That's the official view. Now, these kind of drops are, for me personally, I would say it's personal because we don't recommend officially, it's an opportunity. And we value Bitcoin compared to gold very simply. Gold total market cap is something like $35 trillion. There has been only 200,000 tons of gold extracted from Earth from the beginning. Gold is used for 8,000 years when you think about it. It's, as a currency, that's massive. And half of gold is in jewelry. 25% is in central bank reserve, which will not happen. You cannot have a Bitcoin bracelet or whatever, and the central banks are not buying yet. So you take 25% of this 35 trillion, and you can easily justify a Bitcoin at, I don't know, $800,000, something like that. Now it's very volatile. It doesn't have 8,000 years of history, so you take the discount you want. And for me, if you just do the ratio of volatility, you go to 200,000, and you feel it's not unreasonable to see Bitcoin at 200,000. Now, it's not a recommendation, it's a personal view. We are considering it, but there's Bitcoin and the other cryptocurrencies in the same way that there is gold and the other commodities. You give me 20 seconds on that? Can I elaborate?
Please.
Wonderful. For me, gold is a currency. The other commodities, and including silver, you have copper, which is an industrial metal. We like it for that. Supply, demand, we understand. Then silver, it's a combination between a precious metal and an industrial metal. From an industrial point of view, it's in undersupply. So we've all heard this story. Hey, look, it's in undersupply. It's the case for 6 years, And so when speculation comes, it goes very high, but it's speculation with leverage. So it can go very low. As an investment object, we don't really know what to do with that. While by contrast, gold is a currency. And for me, Bitcoin is a currency. The other crypto, digital, let's say the other cryptocurrency, the level 1, the other blockchains, they have a function. It's like an industrial metal for me. Ether Ether is about smart contract. I have no idea if Ether is better than the next one. I don't know. There is this risk of being displaced, while Bitcoin is just about being a store of value, and we like it for that. So we don't look at other crypto assets. We are about to recommend Bitcoin. We look at gold. Of course, silver, it's very tempting. You can have a fair value, you can have this kind of thing, but with volatility of, 600% as a wealth manager, as a conservative old man in a universal bank, it's difficult to recommend. Copper, we believe. And copper, by the way, you don't need to buy copper. Buy stocks from emerging markets. They are correlated at 90%. Okay. Sorry, I'm going in every direction.
No, that's really helpful. I'm gonna ask you a question. We might have a few people leave the room or fall asleep, but it's about bonds. Bonds for retail investors, Gen Z, millennials especially, was very disappointing. The role it plays was generally to diversify, to hedge or protect you against certain shocks. But we've seen it in 2020, 2022, completely go the other direction. It's also generally too small to protect meaningfully against shocks. So I've generally sold bonds to favor other hedges or other protections. I'd love to understand how people like me and what we're missing potentially about bonds and which role it plays. I told you someone's gonna leave. I'm joking.
That is tough. Sorry. Yeah, bonds. Bonds are boring, That was a slogan in the 2000s. Okay, so being the old man in the room, frankly, not that long ago, you were all very young, maybe at school, but no, just 5 years ago, you had almost zero interest rates. Almost zero. I mean, Switzerland was borrowing at minus 1.5% over 10 years. Can you imagine that? Minus 1.5. You had to pay Switzerland to lend them money, and even France, which is crazy when you think about it, briefly went negative. It's about this diversification power. You're right. It was disappointing. 2022, we had inflation. Inflation kills everything. That's how it is, except for cash. And then even the diversification power of bonds is questionable because we have questions on the sustainability of the debt of the US. So usually when the economy goes in the wrong direction, stocks go down because you have a recession, you have less profits, but bonds go up because you say, hey, central bank will cut interest rates, so my bonds that yield 4% currently, it is going to be 3%, so they gain in value. And this is questioned because now we say when the economy goes down, oh, maybe the US will not pay back their debt. I just exaggerate a bit, so you have this term premium that rises. But still, you make 4.5% risk-free pretty much. Not risk-free at 30 years. Maybe some countries will not pay back their debt, but you have... we like our region for that. You know that the UAE is borrowing money. They don't need at all. I mean, the sovereign wealth of the UAE, it's like 3 years of GDP. They don't need it, but they want to build the yield curve to be present on markets for the future, which is very interesting. And so when the UAE borrows money, our currency is pegged to the dollar. We pay a bit more than the US. We should be negative. I mean, this is like free money. And if you are in the idea, no, I want my capital to generate money for when I retire in 60 years, or maybe in 3 years if you are a successful entrepreneur like Mark. No, I'm joking. No. If you have a 50-year time horizon, yes, go 100% stock, don't ask you any question. If you say, oh, maybe in 5 years I'll buy your house or a robot or whatever, take this money. I mean, 4% per year, it's worth it. It's really worth it.
Awesome. Convinced. I want to switch more into what it's like, just to understand the behind-the-scenes role of a CIO, because first of all, it's just super fascinating, and I'd love to hear what it's like behind the scenes. And I think a lot of us in the room, one thing that's happening is a lot of investors are taking the reins and making their own investments, monitoring trends in the news. So I'd love to see kind of how do you go about making sure all the information you're getting is relevant and filtering what's noise? What are signals that you absolutely rely on almost every day, like a habit? So I'd love to read more or understand more. What are you like reading and monitoring? And especially given such a strong track record, not just as a one-off. To get it every across a longer period of time, we know how difficult it is. So I'd love to just offer the audience an opportunity to learn more about the process, not just how you got to these conclusions.
Okay, hope it's going to be not too boring. Thank you for the question. First, I'm a CIO. Yes, it's a nice title. I'm a glorified bank employee at the end of the day. You take care of people's money, and that pushes you to, there are different ways to do, but it's not your money, so you feel even more responsible. You don't want to have lots of people losing money, so we are probably a bit conservative. You mentioned an important word, which is the process. A CIO, there are many definitions. For some, it's just kind of a spokesperson that speaks on TV. For others, he's never there. He just takes the decision or allocates risk. The common point is you are in charge of the investment process, which means how you build portfolios. And I start with that because that really drives what we look at every day, because you're right, we have so much information and even so many ways to get information. So our process is very fundamental. We look at, first, we build the structure of the portfolio, which is the strategic asset allocation and quantitative models. I mean, if you have 3 years, 5 years, 7 years, we will build asset allocation with no scenario, no emotion whatsoever. We don't know what's going to happen quantitatively to avoid losses over 3, 5, and 7 years and try to get the best possible return. That's the bedrock. And then we overweight and underweight. That's what we do tactically. And that's where the daily information comes, because you underweight and underweight because you think there are opportunities, shorter-term opportunities. So first, it gives you a framework. We never go all in. We will not say, hey, by the way, put everything on NVIDIA. Never. We do small tweaks. Overweight and underweight, we look at 3 things. The scenario, what happens, which is economy, growth, inflation, policy. First thing. Second, valuation. You look at what is priced in compared to what happens. You look for differences. And finally, behavioral factors, where what you like is to see either panic or euphoria. In between, it's not usually very useful. So at the end of the day, back to your question, just as a frame, we start our day by looking at macroeconomic data, because that's the scenario. And frankly, that's what matters, the data compared to what happens. And after years and years and years are looking at 1,000 things, the most important are the leading indicators and the labor market, pretty much. That's the most important. Leading indicators, the PMIs, the ISM, that's something that you have once a month. Simple, above 50, you're in expansion. Below 50, you're in contraction. You look at what the market expects and what goes out, and it gives you immediately a reaction. Over, it's good for stocks and usually bad for bonds and reciprocally. Then labor markets, because and we live a time where we probably have a very important maybe transition, maybe rupture between growth and hiring because of AI. And that's something really to look at. Labor market matters because, again, central banks, they will adjust their policy depending on labor. And that's something important. Then valuation, we look at, we love to find undervalued things. We look at valuation, not that much in absolute, the price earning, but relative to its own history and relative to each other. And currently, China is having almost as much high value-added content as the Western markets, but it's half the valuation, for example, while India is expensive because everybody is invested and expect this growth. And finally, behavioral factors. Currently, we're in euphoria. As a standalone factor, this would be very scary, but I'm not sure. I think we still have a bit of way to go, so we do that. I don't know if it answers your question.
Yeah, of course. I love that you mentioned that the Bank of America sentiment generally that you mentioned is hot, because and it sounds like you don't rely on one indicator, obviously. I think some investors rely on the PE ratio as another example. Are there any other like 2 to 3 metrics that you monitor almost daily or you overweight on compared to all the other numbers out there?
If I want to show off, I would say that we like the kind of a sophisticated P, which is the cash flow return on investment. But forget that. For stocks, we like very much to compare the PE. The PE works. I mean, you have the 2 big valuation ratios are price to book and PE. Price to book is okay. Theoretically, if you close the company, you sell all the assets. What's left? But the thing is that we are in an immaterial world. it worked very well for factories and everything. So in emerging markets, it works. For banks, weirdly, it works as well. For the rest, it doesn't. The US, you pay like 5 or 6 times, while you pay 1 time in China, and it doesn't mean a lot. The PE, we compare it to their own history, and we compare it to the level of interest rates. Just think, as a bond, for example, in the US 10-year currently gives you 4.2%. 4.2, let's say 4, sorry, to simplify the calculation. So you reverse it. If your bond is 25 times the 4% it pays you every year. So the PE of the bond is 25 times. And you look at equities. Equities are 22 times. So it tells you, I'm not paid to take the risk of equities over bonds because it's very close. The ratio is very close. When interest rates are at 2%, and it happened, then it's 50 times for bonds. So your stocks at 22, they are interesting in relative. And capital competes in global investors' portfolios. So that's another way to look at it. For valuation, we are very traditional to that extent. We look at charts a bit, not that much, because we don't do really tactical calls. It's it's also because we are a universal bank with many kind of clients, and we don't want to, in short-term trading, and I'm sure you know it, you're probably better, but you can be wrong 40% of the time and be extremely good. Is it Roger Federer? He said he won 80% of all the games he played by winning like 54% of the points. And if you're in this kind of ratio, it's very dangerous to advise people.
Amazing. That's really good advice, because we sometimes imagine a flawless also track record when it's just a couple of calls and not wiping out from these mistakes ultimately. Are there any publications, investors that you follow that you believe have shaped your worldview or your investments view that you think people should know about?
Yes, of course, and we live a wonderful time. I mean, for all of us, the amount of and the quality of information that is accessible for free today is just absolutely mind-blowing. Including, by the way, that your portfolios that you can build with Sarwa or with a bank in Dubai with a blue logo or whatever. The quality of the portfolio you can build now with ETFs, you have access to 90% of what the top family offices can do. I mean, except a few private assets and co-investment and some hedge funds that are really elite, you can do 90% of that with 10,000 dirham. It's a fantastic time. And when it comes to the gurus, well, of course, for me, Ray Dalio is the smartest of all, and the thing is that he loves to talk a lot. So he tweets, he's on LinkedIn, he does YouTube videos on the rotation of empires, and that's very timely because we are talking about that precisely, but there are many. I mean, there are many.
That's actually the main debate of the next session. It's going to be exactly on that, and informed by a lot of his views. I'd love to ask you, what are some common mistakes you see CIOs make that are maybe newer to the field or not even that you've observed?
Oh my God, mistakes are a very common point. I do mistakes all the time. I mean, we learn every day on markets, and that's why it's so interesting. And I'm so happy to see so many people because it's something that we don't. When you think about the time we spend learning to drive, for example, and the importance of money, we don't learn it. And I'm so happy to see so many people learn it because you can self-learn, and the learning curve is very steep at the beginning. But then we still make many mistakes. I would say the most common is when you arrive at a point of certainty, usually it reverses. For me, I never saw the crashes coming, frankly. I usually, in my career, I was an equity fund manager for long, and I was quite successful, except that I never saw a crash coming. I was very good when the crash happened to react to it. Because each time there was a crash, it was exactly when I was saying myself, okay, now it's only going to go up, and be careful with certainty, and also we take lots of information. The problem is that, and even worse with our brilliant AI chatbots, you can make a very smart investment case for any direction. I can really, literally, and I'm not as smart as an AI, I can in 3 words convince you that the market is going to hell or to heaven, because you can't find information, and we have this confirmation bias. I think the most problem with CIOs is that you believe in something and then you look only at the data that goes in your side. So it's good to, it's not easy. But it's easy on the long term, by the way. The biggest mistake we all make is to try to get rich quick. Yeah, with market. I mean, if you're an entrepreneur, no, I'm joking. But that's the mistake. On the short term, frankly, we never know. But models work spectacularly well on the long term. You wouldn't believe. You can really predict over 10 or 15 years. It works.
That's good news, because investing so hard that it's good news that it's.
But you can trade on the short term. It's just you have to have a discipline. First, how much of your money are you okay to lose? That's as simple as that. And some people are very successful. I'm terrible at that, but some people are very successful objectively. So first, how much money are you ready to lose? And then always set yourself targets of stop loss and take profit. And then, yeah.
I'd love to understand, you mentioned crashes, and in a time like this and with Trump around, we should expect a lot of people are expecting volatility and for us to be glued to some world events. So if we take, let's say, COVID or the tariffs last year or whatever things happen, what is your response? Is it, this is already baked in, we shouldn't be emotional, let it play out, keep a cool mind? Or are you having calls with your team already to see how you are tactically responding or not? I'd love to see what is your style of reacting, if at all, to shocks.
The right word is reacting. I think it's we all want to predict the next crash. I mean, but it's super difficult because precisely it happens. One of the reasons why it happens is that nobody believes in it, and there is a famous sentence from Peter Lynch, I think he said, more money has been lost trying to protect against the next crash than during the crashes themselves. So we usually, currently we are fully invested, for example. There are reasons to be a bit worried, but not everywhere. We like gold, emerging markets. There are things to do. It's when the crash happens that you need to have options. And it's about the reaction. And why is it happening? Is it serious or not? COVID was a tricky one because we didn't know if we were all going to die or not. You know, that's, that's a big question. So it was a difficult one. Weirdly, I'm old enough to say that, but the 2000 bubble crash, I was an internet analyst back in the days for a buy-side firm. It was clear that we had done stupid things, and suddenly you see it and you say, okay, all these companies are worth zero, but Amazon, Nokia back in the days, or Yahoo, I will really sound very old. Yeah, it still was. So it's how you react. And for tariffs, frankly, it was not that difficult to see. When you see President Trump putting tariffs on an island with penguins, you know it's not real. And when you know his book, The Art of the Deal, you know, he wrote this book, he says explicitly, have a stupid ask, you have to traumatize, to terrify people, and then you will get what you want. So on tariffs, it was, I'm not going to say it was easy, it's never easy, but it was clear, it was not the right time to sell. Yeah.
Take it at face value and take a step back. Yeah.
And this year, don't forget, we have the US midterms elections, where worst case for the Republicans, I'm not political, worst case, they lose control of both the House and the Senate, and the Democrats will try to impeach President Trump. They will not succeed in it, but it's going to make lots of noise. I think that the current administration will do whatever they can to support the economy, to avoid a crash. I'm not saying it will happen, they will be successful, but I think that that's what they want. And I see, I know it's a big transition, but with the current market volatility and the reaction to the nomination of the next Fed chair, I think that Trump will not strike Iran anytime soon, because he doesn't want to deal with all that and have a market crash 6 months before the election. It's horrible as a reason. And again, I'm not political, but I I think we have this. At the same time, we have big questions now on AI against hiring. And when you see you've seen the software companies going down because Claude says, oh, we have this new system, you don't need coders anymore. That's a serious thing. We'll see. Yeah.
Amazing. Any last comments that we maybe didn't touch on or principles to leave our audience with for 2026?
For 2026, it's about we start fully invested, relatively optimistic. It's more of the same, less visibility, less upside potential. So it's about taking profit sometime. But the key message is be diversified. Never go all in. I know it's the advice of an old man. I don't know. It's your money. I mean, what you invest is something that you. I don't know. It's a gift you haven't done to someone you love or whatever. It matters, and it's also your future. And I would say. It deserves huge respect and attention, and invest for 4 or 5 years. Don't try to play or just a fraction of your money on silver or on whatever. And having said that, personally, in my personal portfolio, I am currently buying Bitcoin, but that's such a slow pace, just a few dirhams every month, and it's a super volatile asset, and believe in it on the long term. I have no idea where it goes next week. I was not happy. I didn't start buying at 61 yesterday. I mean, I started buying just below, I don't know, maybe 90, something like that. I'm not happy with what happens, but I would do it so progressively that it's fine. It's fine. Sorry, going in.
No, that's amazing, amazing. Thank you, Maurice. I just want to leave one note before we close. A lot of people ask me what are ways of learning about investing, and I just really want to call out his work on LinkedIn specifically. And I really urge you to follow his content. It's like world class, happening right here from Dubai. So thank you, Maurice, and really enjoyed the session.
Thank you very much.